Hi everyone, hope you had a great week. Gorgeous day. Picked up my girl from school and decided it was too good a day to come straight home. Instead we went for a play at the park. Always a great way to finish off the working week. Now if you're not already following us at Future Accounting Ballarat, please do so and please share so that we can help as many people as possible. Now today's quick topic, fringe benefits tax. And within that space we will talk more about motor vehicles today. Hot topic with the ATO. There is some stat out there that suggests there are billions of dollars of tax not being collected as a result of incorrect or non-lodgement of FBT returns. So put simply, fringe benefits tax is an additional tax to employers who provide employees or deemed employees any benefit that is not monetary, so not your usual wages and salaries. So a couple of common ones is super, but fortunately that is exempt from FBT, which is why it is so popular. The other is of course your motor vehicle. Now there has been a long assumption made by small business that it's great to own a vehicle within a company or trust, claim all the running cost and finance cost and depreciation, but there is a trap. First, you can only claim the business percentage. Second, there is FBT, fringe benefits tax. So essentially a couple of ways to work out your FBT taxable value. There is the statutory method, which is a flat 20% of the cost of the vehicle. You then need to gross that up by a gross up figure to get your taxable value, and then, wait for it, it's 47% tax. You heard right, 47% tax. The second method is the logbook method, often called the operating cost method. Now this is where you need a valid logbook and you use the business percentage from that logbook to work out the taxable value of the vehicle. So you essentially apply that percentage to all your operating cost, running cost. There's a deemed depreciation and deemed interest. So even if you haven't financed the vehicle, there is a deemed interest rate that the ATO release each year that applies. So again, you gross that up once you've added all that up together, and then you pay 47% tax on that taxable value. Now the tax payable is deductible. However, remember, assuming a company, you only ever save the tax rate. So only save 25 cents in every dollar of deduction. So you might have a lot of FBT liability of 30 grand. Yes, you get the tax deduction, but you're only saving 25% on that figure. Why is this important? Quite often, unless the vehicle is exempt, that is, the vehicle has a carrying capacity of over 1 tonne and not primarily for passengers, then it can be more costly to hold the vehicle in your entity than holding it in your own name. Now the FBT is coming to an end, so the FBT starts 1st of April and runs through to the 31st of March each year. So if you haven't already done so, make sure your logbook is up to date, and don't forget, before you buy a vehicle, give us a call or shoot us an email or ask your accountant to run the figures to make sure you don't end up paying more tax than you need to. Don't forget, not all utes are exempt. Most twin cabs and vehicles alike are regarded as passenger vehicles and quite often do not satisfy the 1 tonne calculation or commercial vehicle definition. So don't assume, always ask the question and get in contact with us if you need a hand.